Month of August, over. Markets take a pause. Last week, we had some bad news on data, but the market thought it was good news. Now, we head into a seasonally difficult period, the fall, and inflation continues to rise. There is lots to talk about, so sit back and let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I'm a practicing financial advisor. We have a registered investment advisory firm, meaning we act as a fiduciary. We do videos like this, market updates, podcasts, educational videos, so please do consider subscribing. Also, below, show more, we have chapters so you can skip around on today's topics. So in the opening, talked about it. Last week, we got some bad data, bad news, right? Jolts and some other reports, but the market thinks it's good news. Why? Because they think the Fed is going to pause or, better, actually start cutting rates sooner. But how? The Fed's mandate is clear, 2% on inflation, and their favorite inflation indicator, PCE, went up this week. Everyone ignored it, of course, because they don't believe the Fed. So, what's going to happen here as we go forward? We're going to talk about that and a lot more. As always, we're going to start with our cycles. We're going to go to the charts, what keeps me up at night, and then wrap it up with game plan going forward. Let's go to the big board. All right, starting out with our process, multi-pieces that we have here. We'll go over that. We've added another piece this year to help based on some changes in the market. But the backdrop, we always start with the macro side of things, okay? And we utilize these different cycles based on growth, inflation, and policy. Now, we have been in cycle 4, growth slowing, inflation decelerating for quite a few quarters up and actually started last year in January. But last video, if you watch, we made the call. We're switching into cycle 3, which is growth slowing, but inflation is starting to accelerate again. That's called stagflation, okay? We're going to get into that here in a second. So going through each piece, here's your growth side of things. This is earnings, okay? You see it going down. 2 quarters in a row of negative earnings, negative 6.5%. No one's talking about that. Next up, here's your inflation story. Now, you've got the 4.1, which is CPI. Yes, we all know we're paying more than that, but that's based on how the government calculates this and previous comps, okay? But then Thursday, we got PCE, as I mentioned, the Fed's favorite inflation indicator, which is clearly going up, and that's July comps. Wait till they see August, because oil, especially, continues to soar, and other commodities as well, housing and rentals also. So anticipate that they continue to go on, which is going to make it difficult for what? For the Fed to cut or pause, okay? Chart here from our friends at HedgeEye. Fed funds, right, up over 500 basis points, 5% over 15 months. And what this shows you is, I'll zoom in, okay? Each of the different times the Fed is raised, okay, and the effect. Now, obviously, you can see recession, right? You had a decline here in GDP, recession, financial crisis, slowdown, okay? Here's where we are, the biggest in history. The thing is, there's a lag, okay? A 17 to 18-month lag. Here was 15 months. This chart's a couple months old. So we're going to start really seeing that hit in the next couple months, although we're seeing it right now, right? We talked about one of our themes being credit events, and they're coming, okay? We're already seeing it in the commercial real estate side, but as we see rates go up, I mean, I just saw Friday, auto car loans, new, 9%, used, 13%, okay? So the lag effect is true. We're going to take a look at that, but first, let's go to the chart. All right, don't forget, if you like what you see, hit that subscribe. Questions, comments, hit me below, okay? So we work with the charts here. Technical analysis, right? The flow of the markets. I'm only going to show 2 today. Try and be quick. on the S&P. Here's your monthly chart. You've got your uptrend, you've got your downtrend, and we're trying to break out. As I mentioned, right, last month we took a pause, and you could see the red candle there. So we'll see what happens, okay? This month, I think that, again, there's a lot of factors in there which are going to give us more reason to move to the downside as we go forward, okay? Now, the short-term charts, a couple things that stand out to me, okay? Obviously, you see what's going on. We had this pullback, okay? And in the last week, we moved up with some negative news, and I'll talk about that in a second, okay? But some things to point out which are a little bit surprising. Kind of tough to see here because it's so low. The VIX, the volatility index, is at 13 and change. Wow. That is unbelievably low for what's going on in this market. But that's all being driven by this options that we're going to get into, the same-day options, okay? Anything else stand out here? No, the big thing is, which I saw at the end of the month here with that negative news, we moved up, but volume came down. That's a typical month-end markup, which are for mutual funds, etc., trying to mark up and chase some of that performance. But also, being the last week of summer, we're seeing no volume, and the markets can move a little bit quicker based on very low volume. The last chart I'll show here real quick, I've always shown this one, couple things. The blue line is your NYSE, so the full market. The histogram is going to show you new highs minus new lows, right? And when you take a look over here, when we're in 2021, lots of new highs minus new lows, and look where we are over here. Not much. I mean, last week or Friday, 87. Not a lot going on there. We're still not seeing the market breadth. Companies underneath the moving 200-day average is less than 50%. So again, not seeing that market breadth, but we are looking at some other opportunities, and we're going to check that out right now in Sector Spotlight. All right, I do my best to keep these shorts. We're on target. Let's keep moving. So we've got the 10-year Treasury, right? Has not been a good time to own Treasuries since 2020. Well, really, since 2021, because, right, yields go up, prices go down, you're losing money. And I'll talk about that more in a second. Very interesting, all right? We've seen this big move up, kind of a little bit of a counter trend move, but on Friday with quote unquote, right, bad news, the market liked it, but the bond market moved up pretty big for a one-day move. They're not believing what's happening. They're focusing on the fact that inflation is still here, okay? That's what you watch when you're looking at the 10-year Treasury. And the next thing is, I'm going back. Here's your 10-year Treasury. We're talking about a 40-year time frame here. And look at that breakout, okay? That's an unprecedented breakout here. So a lot going on in the markets. And just saw an article. I'll pop up a quick image here. We're talking about never, not since 1787, have we seen 3 years in a row of negative returns in bonds. And think about that typical 60-40 investor. That's why we're tactical. That's why we haven't owned duration bonds, okay? So next up, let's talk about some opportunity. Have spoken about this for quite some time. Okay, we've got Japan. This is the Japan ETF EWJ. Japan, unlike the U.S., they're growing right now, right? GDP went up big time, but we had this little pullback recently. I was getting a little concerned about the risk. So when I build a portfolio, like in this case with Japan, we have 3 different holdings. I will make it risk adjusted. So typically in a bull market, I'll go 6% in a position in an ETF. But I'm much lower than that right now because of the risk I see in the overall market. So we still like Japan as we go forward, but there's a little concern here I want to pull out. I've got Japan in the Qs, QQQ, which is the NASDAQ 100, okay? And you can see they are absolutely correlated. So if we have a pullback in the NASDAQ, that's going to concern me with Japan. One of the reasons why had some profits, moved down our positions, and down the bottom here might be tough to see. That's correlation. So it's showing how the NASDAQ and Japan's correlated. Last week it was 0.91%. One means they move lockstep, right? On Friday we closed down about 0.88. So again, that's one thing that concerns me about Japan right now. So don't want to go too much overweight unless we see a break in that correlation, okay? Next up, energy. So we talked about it. Inflation is coming back, right? Definitively coming back on all different classes within the commodity sector. So for us, rather than complain about it, we've been adding to our oil positions, okay? And you can see oil, right? Nice move to the upside here. Friday, we had a breakout. Actually, very fortunate. Added to our position on Thursday. So when you look at inflation assets, there's different ways to own it. So we've got 2 different ETFs we own. We have an individual company we own, uranium, and then we have 2 other holdings as well. Can't give away everything here in this video, but we've got 6 positions in total that are inflation related, and that's why we see things going forward a good place to be, right? Stagflation with inflation rising. So next up, what keeps me up at night? All right, don't forget, hit that subscribe, right? We've got market updates, my regular podcast, and we're launching a new show with another advisor mid-month called Wednesday Wisdom, okay? So, and any questions, comments, hit me up below. All right, so what keeps me up at night? So this is some of that negative data I want to talk about. The JOLTS report, job openings, okay? And you can see it has really come down. We're talking about the largest move over 3 months in history, okay? So that tells you. Now the market's like celebrating it because why? That negative news, right? They think it's good news because they don't think the Fed is going to continue. And I've said it and I've showed you they're going to continue, okay, even if it's higher for longer, if inflation continues to stay high and sticky. Right now, we've got another CPI report before the next Fed meeting. So right now, though, everyone's saying they're not going to raise, they're done, but higher for longer, okay? Now, another thing I want to point out, which has been real interesting, and by the way, this is not a political statement. Every administration does it. This one seems to be a lot, though. In the past several months, we have seen lower. So numbers come out, and then they go lower in jobs, JOLTS, new housing permits, industrial production, PCE, and core PCE. So the number comes out, JOLTS, no pun intended, the market, but then they revise later, okay? Now, we've seen this big time in employment. We saw our employment number on yesterday, again, higher. Inflation is going, employment went up from 3.5 to 3.8%, and it shows you actual in orange. Blue is the revision. In June, they revised it by 100,000 jobs. What does this mean? We're slowing, okay? This is the slowdown. This is the lag effect of the Fed raising. We're seeing it across the board. Remember, many times I've said this, unemployment is the laggard, okay? So pay attention, watch these numbers as we go forward. Make sure you subscribe to one of our social media channels, and we give you up-to-date numbers here instead of just once a month. Now, with JOLTS, with unemployment, with inflation, consumer confidence went down. Again, another negative. You're seeing it come down further. The consumer is hurting, okay? Now this, I read Google News in the morning and I've got, different sections. This was a snapshot of one section, okay? Credit card at $1 trillion is a sign of consumer strength. What? No, it's not. Then look at the other ones. Delinquencies rise in credit cards. Auto loans could get worse. Spending habits are unsustainable, right? And then the last one, American families may soon max out their credit cards, right? The consumer is the largest part of GDP. They are hurting. I'm seeing it every single day in articles. This is what this slowdown and the potential recession that could come from this, okay? This is reality that's happening out there, not what's happening in the stock market right now. But eventually, they will catch up with each other. And we saw this with Dollar General, right? Big miss. What'd they say? The consumer, and this is a lower-end consumer generally, not buying. Saw it Thursday with one of our analysts with McDonald's. Same store sales, traffic down everywhere. Retail, if you look at the retail sector, XRT, ETF, getting hammered across the board, right? Again, the consumer is hurting, okay? Next up, what concerns me? We've talked about this many times. Government spending, look at it, shooting up, right? Now that was obviously during the pandemic, and then we've got 14%, but look, over here, tax receipts, negative, going down. That is not, I mean, obviously, right? Money in, money out. I talk about that with the financial plan. That is why this deficit continues to grow. And this shows you federal government expenditures from our friends at Tier 1 Alpha, okay, over $1 trillion a year. Interest payments, okay, big problem. Nobody's addressing it. It's going to have to be addressed at some time. Now, the last thing is, not going to get too much into it. I'm hopefully going to do a separate video on this. I've talked about it, right? The options market has exploded, specifically ODTEs, right? Zero date to expiration. Same day options. Sometimes they come in the afternoon and get out by the end of the day, okay? This shows you the surge, again, from Tier 1 Alpha, and you can see them, tier1alpha.com for more information. This is part of the process that I've had to add to better understand, learn, and adjust to move, right, as far as where the markets are moving. So we're seeing a major surge. One day this week, we saw 55% of action in same days. And they come in, and it shows you, right? This is the same day, the ODTE. They come in one day, and they're looking for certain prices. And yes, they can and have moved the markets many times, but it can go the other way. And this is why I want to do another video. This shows you, right, vol control. So a lot of this is being done. One, there's 4 major dealers that are doing it, but it's done by certain control funds, CTAs, that are being bought and sold based on certain algorithms, right? This shows you, this is a few days ago, when the market went down, is basically this can go the other way, as we saw, right? Meaning, when the market starts going, they could start betting the other way and really push the market lower as well. So that's why, fortunately for us, we get daily updates, numbers, what's happening, what the buys are in the market, and it has helped in our process. Let's wrap this up with game plan going forward. All right, so wrapping things up here, bringing it all together, what are we looking at as we go forward? One, again, seasonally, September, October, 2 of the worst months of the year. But again, we'll see, right? We're going to adjust with that. Inflation is ticking up. Let's take advantage of that with buying some of those asset classes. Let's watch what's going on here, right? It is a very fragile time. The data continues to get negative. That lag effect we are seeing, right? We still have large cash positions. We're not in duration bonds, okay? Showed you where we are, so let's be patient. Make sure you subscribe, and we will keep you updated. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.